And then we've got Bitcoin. And, I think the shock of all shocks to those who do not believe in Bitcoin or think it's a Ponzi scheme or are blockchain, not Bitcoin, in their focus. They're shocked that the Bitcoin has gone from 19,000 during the heat of the bank crisis in that second week of March to 29,000. It's a flight to safety. That's what this is. It's a flight to safety. And those who understand the value of Bitcoin as really the Bitcoin blockchain evolving a new global monetary system that is not hostage to any human decision makers.
Hey guys, welcome back to Library of Wealth. Today we have the CEO of ARK Invest, Cathie Wood, discussing Bitcoin's recent surge and the Fed's recent interest rate increase as investors continue to move away from banks due to the string of crashes we've seen recently. Wood believes that the recent surge in Bitcoin price is due to a flight to safety and increasing demand for a decentralized monetary system. She thinks cryptocurrency will eventually become an election issue when the sector becomes more broadly accepted and the public can more clearly see the kinds of regulatory pressure that the United States government is applying on the industry to maintain centralized control of money and monetary policy. Wood also discusses how banks are currently struggling and points out two mistaken assumptions made by bank management teams from 2020 to 2023, assuming that the Federal Reserve would raise interest rates an unprecedented 21 times over the course of 2 years. Let's get right into the latest interview with Cathie Wood, as she gives her prediction for Bitcoin, the Fed, and what we can expect from big banks over the next few months. Before we dive in, don't forget to hit the like button and subscribe to the channel if you enjoy the content we do here. Let's get right into the video.
Bitcoin came out of the ashes of 08-09, and basically it was designed, decentralized, transparent, auditable, as an antidote, a place, again, to go, a monetary system to which investors can flee. And that's exactly what's going on. This move from 19 to 29 was not a flash in the pan. We are still there. And if you look at our Bitcoin monthly, it just came out this week, a couple of days ago, you'll see that the signals, we measure the health of the Bitcoin blockchain in that piece. And you can see the health on a day-to-day basis, and it's very, very healthy. And then there's another market indicator. It's away from fixed income and digital assets. It's commodity prices. All of the prices I usually cite are down from their peaks, and all but gold and silver are down on a year-over-year basis. And we're watching gold very carefully. It, like Bitcoin, and to some extent silver as well, are flights to safety if people don't trust the banking system. But we also have to be mindful that gold is a very good inflation gauge. It peaked in August of 2020, and it's still in the range that has been in place since then. But we're paying close attention. Is it rising? Is the price rising because of a flight to safety? We would suggest so. But there's always that risk that gold is picking up on fears also that the Fed, those who don't believe the Fed should ease, and we're not in that category, but there are many people out there and who worry that the Fed will pivot, might be hedging that possibility with gold. What is the incentive for investors to move funds into banks when they're seeing deposit outflows, which may be accelerating for all we know? We know money growth is coming down at an accelerated rate, and demand deposits are the biggest part of money growth. Fed has just raised rates. That's another incentive to move away from these banks that are somewhat hamstrung in terms of competing with money market funds, because during COVID, they made two mistaken assumptions. And I'm going to, unlike a lot of people, I'm going to say those assumptions were understandable. And I wish that the administration would focus on that instead of making these bank management teams out to be, really stupid. and irresponsible almost. The two assumptions were, and this was in the heat of the COVID crisis, when deposits associated with stimulus payments were flying into the banks. Their deposits were increasing at a very rapid rate, and they needed to decide what to do with that money. So they bought government-backed securities. They bought safe securities and put them into a category called held to maturity or hold to maturity. They were yielding 1.5% in the 1.5% range. Well, if you thought short rates were going to be 0.2% by now, that would be a nice spread. That was a decent yield. So that was the first mistake, not assuming that the Fed would raise interest rates 21-fold within a couple of years' time. The second mistaken assumption, also understandable, was that deposits would not leave the system. And that's because deposits generally don't leave the system. Over history, they've been going up over time. In fact, the only time M2 has declined on a year-over-year basis ever was during the 1930s, the Depression. Deposits have had an occasional dip below zero, but quickly reversed. We're not seeing that this time. And again, it has never happened since the Great Depression. And so you can understand why management teams said at the time, well, even if we're buying these securities at 1.5% yields, other deposits will come in over time and we'll buy treasuries at higher and higher yields. And so you can understand what happened. This week, the Fed did increase the Fed funds rate again, 25 basis points. We're now at 5.25, 21 times where we were a little more than a year ago. So a 21-fold increase in interest rates from 25 basis points to 5.25. Now, never has the Fed raised rates in the middle of a crisis. And they do seem still to be separating or compartmentalizing what's going on. We have the tools to deal with a crisis, and we're doing that. And we need to fight inflation as right now a primary goal of monetary policy.
Wood points out that the Fed has never before raised rates in the middle of a crisis, and they seem to be compartmentalizing the current crisis we're seeing, which is counterproductive to fighting inflation. She argues that the Fed deserves blame for the current situation with regional banks and believes that investors may be concerned about how the current administration and the Fed are treating them. What do you think about Cathie Wood's prediction for Bitcoin, the recent move by the Fed, and what we can expect from big banks over the coming months? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.